We have with us our second speaker of this program, CA Mohit Bhuteria. I start with a famous quote of Alvin Toffler, who said, "The illiterate of the 21st century will not be those who cannot read and write, but will be those who cannot relearn, unlearn and learn." So the biggest challenge before us is to forget what we have been all doing across and to concentrate what we have to do in the future under the new law. As we all know, 60% of the present legislation is notified. 98 sections in the first round and another 184 sections in the second round have been notified. We have 29 chapters, rules have been notified for majority of the chapters. Then we have around 100 notifications, circulars, removal of difficulty orders. We have one Companies Amendment Act 2014. The challenge lies in collating all these laws together, all these act, rules, notifications, removal of difficulty orders and circulars together. And a bigger challenge lies in to ensuring that whether the notification which has come has been notified or not. When I deal with companies auditor's report, or let me tell you before I go to depreciation, we all know the companies auditor's report was issued on 10th of April 2014 and said to be effective from the date notified in the official gazette. The largest corporate of India, the largest private sector corporate of India, issued its audit report on 17th April 2015. It is one financial statement we practitioners always are willing to see or always look upon when we prepare our financial statements. In that financial statement, Caro was not there. We were taken aback as to how Caro, which has been issued on 10th April 2014 to 10th April 2015, and on 17th April 2015 when this balance sheet has been signed, Caro is not there, because that company has perhaps the finest brains of the country. Innovation, we call it a company of innovation. Thereafter, they issued sometimes another 1 week later a mail to all the shareholders stating that Caro was not notified on 17th April 2015 in the official gazette. It was on a back date notified with effect from 10th of April 2015 in the official gazette, and there it was only due to that Caro was not there in their annual report. And subsequently, as a mark of good governance, they have issued the company's auditor's report order as a supplementary to the annual report. So just imagine if a large corporate of that size, the largest private sector corporate of that size is not aware, because we have one hard copy of the gazette which is published by the government and one is the e-gazette. So normally we look into the e-gazette for any notification. So if a notification is issued, it is then we presume that if a notification is issued, it must be gazetted in a day or two. But a notification issued on 10th April not gazetted till 17th April. Gazetted sometimes around 23rd or 24th April and said to be effective from 10th of April. Then how do we professionals cope with that? So that is also a big challenge. So now I start with my first topic given to me on depreciation. So what basically I wanted to say through all this is that while auditing our financial statements, we must be very, very careful this year. While dealing with advising clients on the subject, performing assurance services this year, we need to be very, very careful, because it will take time for the law to settle down. It will eventually be settled down in the next few years, but in the intermittent period, in the initial few years, we have to be very, very careful in performing our audit at its function, because we also know that under this new law, we have a new body, National Financial Regulatory Reporting Authority. And this will take over the regulation of regulatory mechanism of chartered accountants from our parent body, Institute of Chartered Accountants of India. So we need to be very careful when it comes to preparing financial statements, because now anything happening, not only MCA is there, but NFR is also there to look upon us. So we need to be very careful. With this, I start upon my first topic on depreciation. Depreciation, as we all know, under the old law was governed by Schedule 14, Section 205 of the Companies Act, and Accounting Standard AS6 notified under the Companies Accounting Standard Rules 2006. With this new act coming in, Schedule 14 is replaced by Schedule 2. Schedule 2 was notified by notification dated 26th March 2014, effective 1st April 2014. But you will be surprised, it was notified by notification dated 26th March to be effective from 1st of April. But again, there was a substantial amendment in this Schedule 2 by notification dated 31st March 2014, effective 1st April 2014. Within a span of 4 days, there has been major amendments to this Schedule 2. And thereafter, subsequently, again on 29th August 2014, by another notification, Schedule 2 has been amended. So when I have to read depreciation, I must consider the provisions of Schedule 2 as per notification dated 26th March, as revised by 31st March and 29th August 2014 notification. Because there has been major changes. What has come initially and what is present now, there is a substantial difference between the provisions. So the framework for depreciation under the new law is Schedule 2, Section 123. And we have the accounting standard AS6 under the Companies Accounting Standard Rules 2006. So what is depreciation? We all know. It is a measure of wearing out of the asset, consumption of the asset, or loss of value of the asset from use, efflux of time, obsolescence and technological factors. So we are mandated to charge depreciation so as to recover a portion of the cost of the asset each year. The term depreciation was not defined under the Companies Act 1956. It has been defined for the first time under the Schedule 2 of the Companies Act 2013, and it defines depreciation as systematic allocation of the depreciable amount of an asset over its useful life. And again, it defines depreciable amount as the cost or another amount substituted for cost less its residual value. These two definitions are very important. What is depreciation and what is depreciable amount, and why it is very important? When we come to the later part of presentation, we say it has changed the gamut for calculating depreciation in certain cases. This depreciable amount of an asset is the cost of an asset or other amount substituted for cost less its residual value. Now let us see what we have been doing all along in the past under Schedule 14 of the Companies Act, so that after we understand this, we will try to correlate with what we are supposed to do under the new Schedule 2 of the Act. Depreciation, as we all know, it was charged under Schedule 14 on cost method. So if the cost of an asset is 1 crore, rate of depreciation is 13.91%, we used to apply depreciation on the cost of the asset and subsequently on the opening WDV of the asset, if we are following return down value method of depreciation. So life was very simple for us. There was never a concern for us in the past when it comes to charging depreciation, because whenever we used to audit any financial statements, our auditors used to calculate the depreciation, and it was fairly a simple task. Just take the opening WDV, apply the rates, addition, apply the rates, pro rata over the addition. If there is a sale of assets, apply the rates of depreciation till the sale, calculate the profit and loss. So charging of depreciation was never a complex subject, and I tell you, even this is now under the new law not a complex subject. We need just to understand, and once we have understood, you will find this depreciation calculation fairly simple. Yes, one time is implementation is a challenge, because when anything comes new, its implementation is a challenge. But after we have understood once, it is not at all it will appear to be a very simple subject. So under Schedule 14, rates were prescribed for plant machinery 13.91, for computers it was 40%, for factory buildings 10%, non-factory 5%, so on, both for WDV and SLM. So we used to simply apply the rates. There was no concept of residual value. we used to apply rates on the original cost of the assets or WDV depending upon the method. There was separate rates for double shift and triple shift. If our asset has been used for double shift for a part of the year or whole of the year, or triple shift for a part or whole of the year, rates were prescribed and we have to simply apply the rates of depreciation on the cost of the order WDV of the assets. Assets costing less than 5,000, it was depreciated at the rate of 100%. There was no mandatory concept of component approach. Accounting standard AS 10 stated that companies should adopt component approach while capitalizing fixed assets, but it was only a recommendatory provision. It was not mandatory. If I have to capitalize this building, I could capitalize this building as a single block office building. I need not capitalize building into components as exterior or interior walls, ceilings, flooring, structure, nothing doing. We capitalize this as a single building. Ind AS, which is effective 1st April 2016 for certain class of companies, also mandates adoption of component approach. But this standard, our old standards did not mandate component approach. Schedule 14 prescribed the minimum rates of depreciation. Whatever rates were there in Schedule 14, we had to apply those rates. We could not deviate from the rates of Schedule 14 below what is prescribed. So if the rate is prescribed is 13.91 for plant machinery, we could not have adopted 12%. But yes, we could have adopted 15, 16, 17% based on technological evaluation and disclosure thereof in the financial statements. We were not permitted to reduce the rates of depreciation because we had an old MCA circular which stated that rates of depreciation prescribed in Schedule 14 are the minimum rates of depreciation and each company needs to provide depreciation based on the rates provided in Schedule 14. If there has been a revaluation, if an asset has been revalued, what we used to do, say there is an asset with a WDV of 1 crore, we revalue it to 10 crores. So 9 crores is credited to revaluation reserve. And then how do we calculate depreciation? We calculate, say assuming the rate of depreciation is 10%, we calculated depreciation on 10 crores, it came to 1 crore. Additional depreciation on account of revaluation of 9 crores was 90 lakhs. We transferred from revaluation reserve 90 lakhs to the PL account 90 lakhs. So in our profit and loss account, the net amount of 10 lakhs was only provided on account of depreciation. So even if we have revalued our assets, our profit and loss account was not hit and the charge remains same. Yes, of course, revaluation, company adopted revaluation to give a healthy picture of the balance sheet to the stakeholders or to their lenders. That was perhaps the main reason of revaluing the asset. Now, if there has been a fluctuation on account of foreign exchange, how do we charge? If we have acquired an asset for 1 crore, if due to foreign exchange fluctuation, there is an additional liability incurred of 2 crores. So, how do we charge depreciation? On 1 crore depreciation, original cost, we charge depreciation based on the rates given in Schedule 14. After 2 years, say there is a foreign exchange fluctuation of 2 crores, then how do we charge depreciation? This depreciation on 2 crores was provided on the basis of the remaining useful life of the asset, prospectively over the remaining useful life. Say the rate of depreciation for plant and machinery was 13.91%. So did it have a useful life? Yes, it had a useful life. Ministry based on the useful life calculated the rate of depreciation. So the useful life for plant and machinery was 21 years under the old law, and that is why the rate of 4.75 on SLM and 13.91 on WDV, that was the empirical rate calculated by the MCA. So if I say the rate life of machinery is say 20 or 21 years, say after 2 years or 3 years there is a foreign exchange fluctuation. So when I acquired the asset for 1 crore, I charge depreciation at the rate of 4.75%. Now there is a foreign exchange fluctuation and there is an increase in liability by 20 lakhs say in the year 3. So whether on this 20 lakhs I will apply 4.75% or some different rate. Accounting standard AS6 said that whenever there is a liability or increase on account of foreign exchange fluctuation, on that 20 lakhs provide depreciation on the prospectively on the remaining useful life. So if my life is 20 years and 2 years have elapsed, then the remaining useful life is 18 years. So on that 20 lakhs I will provide depreciation on the basis of the remaining useful life. I have to calculate a rate based on 20 lakhs, the remaining useful life is 18 years, so what should be the rate of depreciation? So that is how we have all been doing. Similar treatment was in case of revaluation reserve. If it was revalued, depreciation on the revalued amount was provided on the basis prospectively on the remaining useful life of the asset. So if I have my plant and machinery I have revalued after 10 years and remaining useful life is 10 years, so on that incremental 9 crores, I will provide depreciation over the remaining useful life, that is remaining 10 years. So that is how we have been all along doing. Now with this background, let us come to what is there for us in Schedule 2. Section 123 of the Companies Act says that no company shall declare dividend without providing for depreciation in the manner provided in Schedule 2 of the Companies Act. Accounting standard AS6 still remains in statute and we have to comply with accounting standard AS6 as well. By virtue of section 133 of the Companies Act, the central government has said till central government frames new accounting standards on the recommendation of Institute of Chartered Accountants of India in consultation with NFRA, whatever accounting standards are there under the accounting standard rules, they will continue to be vogue in force. So what is there under this new law? Under this new law, we do not have any concept of rates of depreciation. There is no rate of 13.91 for plant and machinery, or for that matter 40% for computer or 10% for factory building. They have given the useful life of the assets. For plant and machinery, they have stated that the useful life is 15 years. For computers, they have stated the useful life is 3 years. For office equipment, they have stated useful life is 5 years. For factory buildings, other than RCC structure, with RCC structure, for non-factory buildings, for each of the assets, they have stated a useful life. So now they have stated that based on this useful life, you calculate the depreciation and you calculate and you charge the depreciation. I will not give you the rates, you yourself calculate the rates. The question arises, why was there a need for implementing Schedule 2? Why was there the need for transiting from rates to life? What was the need? Ministry understood that first, on account of technological obsolescence, the assets are obsoleting fast. If you see the old law, the life of computer was 6 years. Under the modern era, with technology changing daily, on a daily basis, almost on a daily basis, a PC which we have brought today, 2 years after a PC, we find the technology obsolete. New technology has come in. iPhone, today is 5, 6 months down the line, we have iPhone 6, 6X, so on. With computers also, we had Windows 98, then 2000, then XP and whatnot. So technology is changing very fast. 10 years ago, we used to prepare balance sheet on Lotus, 10 or 15 years if you remember. We had WordStar, then we came to MS Word, we have Excel. So technology is changing very fast. So they say that on account of technological evaluation, the charge of depreciation to the financial statements is not being able to recover the cost of the assets. So that is why they felt that there is a need to revise the rates of depreciation. So they could have revised the rates upward. Say for computer, instead of 16.21 on straight line method, they could have said 30% on straight line method. They could have stated that, but they stated no. We need to let the corporates know what is the life we ministry feels is ideal on a general basis, on an overall basis for different categories of assets. So if I know what is the life, I can also take a judgment that yes, today I have acquired a computer, the useful life is 3 years under the new law. So within 3 years I have to recover the cost. If they give a rate, you see, life catches mind fast than rate. Calculation for auditors is simple when it comes to rate rather than life. But just imagine for the industry, life becomes easy. Life becomes easy as well as for providing for replacement cost in the financial statement. It becomes easy for them to understand, yes, this is a computer with a life of 3 years, this is a machinery with a life of 15 years. Within 15 years I have to recover the cost of the asset. So now they have prescribed the life of the asset and they have stated that based on the life you calculate and charge depreciation. So what they have stated that depreciate the asset over its useful life or remaining useful life. They have also called the concept of residual value. So in substance, what the provision says that from the day this schedule coming into effect, depreciation on the assets shall be charged prospectively over the remaining or the useful life of the assets. So if I have acquired a new asset today, depreciation will be charged over the useful life of the asset. So say I have acquired, they have also talked of a concept of residual value, and they have said that the depreciable amount will be the cost of the asset less residual value, and they have stated that residual value should not be more than 5%. So assume we have acquired an asset for 1 crore, we have acquired a computer for 1 crore. They say the residual value is 5%, that comes to 5 lakh. Say we have acquired a computer on 1st April 2014 for 1 crore. So residual value is 5 lakhs. So what is the depreciable amount? 95 lakhs. The life under the new law is 3 years. So 95 lakhs has to be depreciated prospectively over a period of 3 years. So if I say 95 lakhs is to be depreciated over 3 years and I am following SLM method of accounting, then my depreciation will be around 32 lakhs each year. Calculations are fairly simple. But if I say my method of calculating depreciation is return down value method, so it will be say 40 lakhs in the first year, 35 lakhs in the second year, and maybe 30 lakhs in the third year, so on. So it will be on a reducing balance basis. So calculations, we have some empirical formula as to how to derive the rates based on the life. So calculations are fairly simple. If I have acquired an asset for 1 crore on 1st April 2014, life is 3 years, then this 1 crore will be depreciated over the next 3 years based on some formula either under WDV or under SLM method. Now what happens to, and we have to keep residual value at 5%. For the time being we assume that we keep the residual value at 5%. Now come to a situation we have acquired asset prior to that. Say we have acquired a computer on 1st April 2013 for, yes please. Yes. 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 We'll come to each one. Yes. After I complete this slide, I think I will cover majority of your questions which you have in mind. Then you ask me all the questions. So if I have acquired a computer on say 1st April 2014 and assume I am following straight line method of depreciation. So first year we have charged the rate of depreciation is 16.21. So on 1 crore the depreciation amount comes to roughly 16 lakhs. So we are left with 84 lakhs as on 1st April 2014. Now what is the useful life under the new law? It is 3 years. What is the remaining useful life? 2 years. What is your WDV as on 1st April 2014? 84 lakhs. What is your residual value? 5 lakhs. So what is your depreciable amount? 79 lakhs. So this 79 lakhs has to be depreciated over 2 years. So calculations are very simple. It will come to 39.5 lakhs. Here the calculations appear very simple. Let us take a little complicated. Instead of 1st April 2013, I acquired an asset on 1st October 2013. So first year I charge depreciation of 8 lakhs. Instead of 16%, I charge 8% roughly. So my WDV as on 1st April 2014 is 92 lakhs. What is the remaining useful life? 2.5 years. So this 92 lakhs less residual value is 5 lakhs. The 87 lakhs I have to depreciate over 2.5 years. So here maybe if we are using Excel, calculation will be simple. So in WDV, in SLM method, calculation will be very simple, 87 divided by 2.5. But when it comes to WDV, calculation will be a little difficult. Now instead of 1st October, say I purchased it on 15th of October, say, and instead of 8 lakhs, say I charge 7 lakhs, say, hypothetically. So what is the life expired? 5 years, life expired is 5 months, 15 days. So what is the remaining useful life?
2 years, 6 months, 15 days.
2 years, 6 months, 15 days. So that comes to how much in terms of years? 2 years, 6 months, 15 days. And now we have to allocate this 93 minus 5, that is 87 lakhs over 2 years, 6 months, 15 days. So calculation becomes a little difficult. There we have to take a judgment. If we are able to calculate using Excel or using any software, very good. If we are perhaps not able to calculate, because it will not be only one asset which you have, which is a life of 2 years, 6 months or 15 days. You may have an asset which has a life of 6 years, 10 months, 9 days. 13 years, 6 months, 4 days and so on. You have a long list. If your plant machinery is 1,000 assets, you may have remaining useful life, 1,000 remaining useful life, ranging from 10 years, 5 months, 4 days, 6 years, 7 months, 2 days and so on. It will be a long list. So there, based on materiality, you have to take a judgment whether I can ignore the days. Instead of 2 years, 5 months, 15 days, can I take 2 years, 6 months, or can I take 2 years, 5 months? That is a materiality call which as auditors we have to take or clients have to take. Again, instead of 2 years, 5 months, I may also choose, if my list of assets is long, running into say thousands and thousands of assets, I may even choose to ignore a part of the year. Again, materiality is important. Law does not say you can ignore. But general instructions to the accounting standards, what I call preface to our accounting standards, says that accounting standards are intended to apply to items which are material. We have also auditing standard on materiality. If in the judgment of the auditor anything is not material, you can choose to ignore that. If a client, instead of following on materiality, he chooses instead of 2 years, 5 months, 15 days, 2 years, 5 months, right? He calculates the depreciation. You will say no, you have calculated on 2 years, 5 months, you should have calculated on 2 years, 15 months, 5 days. He will say, okay, you qualify your report. I find the total depreciation, say, I choose to calculate the depreciation based on 2 years, 15 months, 2 years, 5 months, 15 days. He calculated the overall depreciation at say 1 crore. I calculated the overall depreciation say at 1 crore 1 lakh. Will I qualify my report? If it is material, I will. If it is not material, so we have to choose a material concept. And maybe in the first year, in this first transitional year, we have to take certain calls depending upon the number of the assets and materiality. We have to take a judgment as to whether if I choose to ignore day or month, whether it will have a material impact or not. We have to take it. It further says that in respect of assets whose useful life has expired, I may have certain assets in my block whose useful life as per the new law has expired. Then charge the carrying amount after retaining useful life to retained earnings or to profit and loss. The language of the law is from the date the schedule coming into effect in respect of assets whose useful life has expired, the depreciable amount, the carrying amount less residual value may be charged to retained earnings. The word used is may be charged to retained earnings. So say we have purchased the computer on 1st April 2011. 1st April 2011 we are following SLM method. First year financial year 11-12 depreciation is 16 lakhs. Second year 16. Third year 13-14 16. So WDV comes to 52 lakhs. What is the depreciable amount now? If I have to say 52 minus 47 lakhs. So what is the remaining useful life? 0. So what we will do this 47 lakhs? We may charge this 47 lakhs to retained earnings. They have used the word may. Earlier the word was shall. When the original notification was there, it was with the word shall. Then they replaced this word with may. And it has its own reasons why they have replaced shall with may. So calculations are fairly simple. If the useful life of this asset has expired, as we have discussed, so for 47 lakhs, what we will do this 47 lakhs, we will charge to either retained earnings or we will charge to profit and loss account. Now let us discuss. If I choose the option to charge this 47 lakhs to profit and loss account, how will I present this item in my financial statements? Is it a recurring item? Is it an extraordinary item? Is it a prior period item? What is this? It is a change in estimate. Initial, the estimate was 6 years for calculating depreciation on computers. Now the estimate has been revised from 6 years to 3 years. So what we will do this amount? We will charge to profit and loss account as a prior period item. Is it a prior period item? No. Is it arising out of any errors of omission or commission? Is it extraordinary? Something extraordinary has happened. There is an earthquake, there is a loss by fire, nothing. It is due to application of introduction of a law, revision in estimates. We have an accounting standard 5, prior period item, changes in accounting policy and changes in accounting estimates. What it says, if there is a change in accounting estimate which has an effect on your current profits or on your future profits, impact thereof must be disclosed in the financial statements. So we will show this as a separate line item in our profit and loss account. This 47 lakhs will come as a separate line item in profit and loss account if in our statement of profit and loss, if it is material. If it is not material, we may choose to ignore and include with depreciation, but if it is material, and perhaps as first year we should show it as a separate line item in profit and loss. Where will it come? We show profit before tax and non-recurring item, then we have a separate line item, non-recurring item, adjustment under transitional provisions of schedule 2. So this amount will come, and then we have profit loss before tax, then we have profit provision for tax, then we have profit after tax. But say I choose the option to charge it to retained earnings. Say I choose the option to charge it to retained earnings. So how much will I charge to retained earnings? I have an opening balance of rate of profit and loss 5 crores. I have to charge this 47 lakhs to opening balance of profit and loss. Can I charge it? Yes or no? Yes. How much will I charge? Will I charge 47 lakhs or something else?
Net of tax.
Yes. It should be net of tax. Because if I charge entire 47 lakhs to my retained earnings, to my opening balance of profit and loss, the deferred tax impact of this 47 lakhs will be debited or credited in my profit and loss account. So assuming my rate of tax is 30%, effective rate of tax is 13%, so 47 lakhs into 70%, that will be charged to your retained earnings. Because when we do calculation of deferred tax, that will be automatically adjusted in our tax calculation, deferred tax calculation. So this is how we implement the transitional provisions, and when we have implemented the transitional provisions, either through PL or through reserves, we will give a note to the financial statements. Notes to the financial statement that we have applied transitional provisions in respect of assets, and due to this, either we have charged to retained earnings or we have charged to PL, and what is the impact of profit and year-end fixed assets due to this change. 2-3 questions more arises. I'll take your all questions after this slide. Number 2. Yeah. No, not necessary. No, not required. Not required. Because in PL you will show only one item of deferred tax. So, say we may do calculation separately, but ultimately I am talking of the net effect. The net effect will remain the same. So, if I have say, let me calculate deferred tax the way I am calculating in the past. I will always use the effective rate of tax. What is your enacted rate or substantively enacted rate? So today, if my company is paying us a surcharge of 10% and the next year it is 12%, I will take the rate as 30% plus 12% surcharge plus 3%. Say it comes to 34 or 35%. So the tax rate is 35%. This means what should my go to retained earnings? 65%. So I charge, say if my adjustment is 47 lakhs, 47 lakhs into 65% will go to retained earnings. This 35% will be taken care of when you calculate deferred tax on an overall basis. So that will be automatically adjusted. Now a number of questions arises. I have charged depreciation under these transitional provisions as a separate line item in my financial statement. As a result of this, my profit turns into loss. I had a profit of 1 crore. Under transitional provisions, I provided for, say, an amount of 2 crores. This has resulted in a loss of 1 crore. So, can I declare dividend? Can I declare dividend? No, I cannot, because dividend has to be declared after providing for all charges, costs, expenses, depreciation. I cannot declare dividend. If my managing director is drawing remuneration based on certain percentage of net profits, and say he is eligible for commission at the rate of 3% of net profits. So what will happen? Will he enjoy any remuneration? Yes or no? No, because again profit has converted to a loss. So that managing director is a good sufferer when it comes to transitional provisions. How will we deal this adjustment under transitional provision for our tax purposes? Say we had a profit before this transitional provision of 4 crores. Now we have a 3.5 crores of adjustment under transitional provisions due to assets whose useful life has expired. From 4 crores, 3.5 crores drawn, we have a profit of 50 lakhs. Will there be any impact on our tax calculations? Do you think there will be any impact on our tax calculations? Yes or no? No? No. Our liability to pay MAT will be on 4 crores or on 50 lakhs?
50 lakhs.
50 lakhs, so our liability is reduced. Will we get the benefit of this 3.5 crores in computation of book profits? Will we get the benefit of this 3.5 crores in computation of book profits? Possibly yes, because it is an amount which we have charged in accordance with law on the historical cost of the asset, right? We have a very old judgment of Supreme Court in the case of Apollo Tyres, where the Honorable Supreme Court has stated that the accounts are certified by the auditors in conformity with Schedule 6. Now we have Schedule 2, and in conformity with the accounting standards, AO has limited power to alter the computation, save and except for items of addition which is there in 115 JV. So this adjustment does not form part of any adjustment in one of the line items of 115 JV. So we can safely conclude that we should get deduction from computation of book profits for this 3.5 crores. Now let us discuss another issue. We value stock. When we value stock in trade of finished goods or WIP for that matter, we take into account certain depreciation as a percent, certain depreciation on machinery, factory building as a part of direct cost when we do the stock valuation. When we do the stock valuation of finished goods, we have direct material, direct labor, overheads. We have also depreciation on machinery and factory building. Now see, if those depreciation items, those depreciation on machinery and factory building, something comes under transitional provisions, will you include this as a part of cost of your fixed assets? Is it a normal depreciation? It is not. Is it a normal charge to depreciation? Because whenever we do stock calculation, we consider only normal cost. We ignore any non-recurring or abnormal or one-time cost. So this is a one-time adjustment. So can we conclude that we will not include this line item adjustment under while valuation of finished goods? Can we conclude or we cannot conclude? All of us say that we should not include. Will we include this in while valuation of stock, this amount of adjustment? No, will not include, so it will not form part of your valuation of stock in trade. Now what they have stated that whatever life we have stated, if I have stated the life of plant machinery at 15 years, life of computer at 3 years, you can follow this life. You can also choose to follow a life which is different from what they have stated in the schedule. And if you exercise the option of charging depreciation based on a life which is different from what is there in the schedule, instead of 15 years, I will charge depreciation on plant machinery based on useful life of 20 years or 10 years. They permit both. They permit both. So you can have a life instead of 15 years of 20 years, instead of 15 years, 10 years, provided it is supported by technical advice and disclosure is given in the financial statements. So if I, instead of 15 years, if I follow 20 years, what will happen? My charge of depreciation in the financial statements will get reduced. Instead of 15 years, if I have a useful life of 10 years, what will happen? The charge will increase. So under this new law, we have the option, we can provide higher depreciation or lower depreciation. But under the old law, MC has given a circular that Schedule 14 rates are the minimum rates. You cannot charge depreciation at a rate lower than what is prescribed in Schedule 14. But now it says that if the life is different, you can choose a life to be different. So if it is different, it is both higher, both lower. Here comes a contradiction. EPC Accounting Standard 6, they say that the rates given in the statute are to be constituted as minimum rates. The rates given in the statute are to be constituted as minimum rates. If I take this as correct, then how can I have a life which is higher than what is prescribed in Schedule 2? So instead of 15 years, if I charge depreciation on 20 years and say I am following SLM method, I will come to a rate of around 4.5% instead of if I had followed 15 years, it would have come to a rate of 6%, around 6%. So there lies a contradiction. But if there is a contradiction, what we are supposed to do? Law prevails. So section 123 section 123 states that you have to provide depreciation as per schedule 2, we provide as per schedule 2. So there lies one contradiction. Now, yes. Now they say that you can do this by technical advice. What is a technical advice? Is it an internal technical advice? I have a team of engineers. Can they give technical advice? Or it has to be a external technical advice? They are very silent. They have just used the word technical advice. Let us see section 138, internal audit. No, not required. If you follow the light which is given in schedule 2, nothing doing. You can choose and if there is a change you have to do this. Both. Yeah, instead of 15 you have the option to follow 20 or 10. If you follow 20 or 10 you have to give a minimum rate AS6 says. But schedule 2 says that you have the option of both. A light which is different from what is there in schedule 2. It can be higher and lower. So I said that to that extent, in my view, it contradicts accounting standard AS6. But law will prevail. If the law prevails, then you have the option of both a higher and a lower useful life. I have to seek technical advice. Now, I am just trying to recall section 138 dealing with internal audit. When it comes to internal audit, they have stated, or MCA has stated that internal auditor has to be a chartered accountant or a cost accountant or any other profession. Now it says a chartered accountant or a cost accountant. The question was raised, can the chartered accountant be an employee of the company? They have said yes, very well. A chartered accountant can also be an employee of the company and he can be the head of the internal audit. So you may have an internal auditor within your organization headed by a person who is a chartered accountant. Can we do the same thing for depreciation, for revising useful life of assets? Can we say management gives a certificate that, see, this is my team of engineers, they have stated that instead of 15 life will be 40 years. Will you accept this advice? Obviously.
In case of Maruti,
Yes.
they have relied upon their own technical.
Law permits that. But when it comes to we as auditors, we may seek an external, a second opinion of some external person. Again, it depends. If the auditor is reasonably satisfied that yes, whatever they have, say many companies have earlier revised their useful lives when it was scheduled 14 also. And say if it is in continuation of that, earlier the useful life was 21 years. They revised the useful life to say 15 years or 25 years. And now even under the new law, they want to follow that number of years. Possibly even based on internal advice, internal technological evaluation or internal advice, we may choose to follow that. But say we have a client who was never revising its useful life. It was following schedule 14. Earlier it was following schedule 14, depreciating machinery. Now it says that no, I have the option to revise my useful life because it finds that if I do not revise my useful life, there will be a higher charge of depreciation in my books of accounts. I do not want to provide higher depreciation because it affects my managerial remuneration. It affects my ability to declare dividend. I will not provide. I, instead of 15 years, choose the option to depreciate the asset over 30 years based on advice of my internal team. As an auditor, whether we will accept? Perhaps not. Again, it is a matter of judgment. But law is very silent. It says only technical advice. We can interpret it as both internal as well as external technical advice. Residual value, they have stated that it should not be more than 5%. And if it is more than 5%, again it should be supported by some advice. Extra shift depreciation, what they have said, if your normal depreciation is say 1 lakh, you have used the asset for double shift, increase by 50%. Instead of 1 lakh, it will be 1.5 lakh. Very simple. If it is used for triple shift, increase it by 100%. Instead of 1 lakh, it will be 2 lakhs. Again, very simple. So, but it has to be calculated based on pro rata over number of days. Say, we have a plant and machinery with a cost of or WDV of say 1 crore. Assume the rate of depreciation under the new law is say 20%. Assume. So on 1 crore, what will be the normal depreciation? 20 lakhs. I have used my asset throughout the year for double shift. it will be increased by 50%. Instead of 20, it will be 30 lakhs. I have used my entire assets throughout the year for triple shift. So instead of 20 lakhs, it will be 40 lakhs. But if I have used for a part of the year, I have to calculate on pro rata basis. So calculations are fairly simple. What about assets costing less than 5,000? Do we have to apply 100% rate? No. They have not provided for explicit 100% rate in respect of assets costing less than 5,000. So that will be subject to the same rate of depreciation, same useful life as we are doing for other assets. So if I have a machinery costing less than 5,000, so whatever depreciation I am charging based on the useful life for a machinery costing of 1 lakh, the rate will be similar. So no separate rate has been prescribed. No, we cannot. Yes. We have an application guide also. It says that on considerations of materiality, you can choose the option to depreciate assets costing less than 5,000 at the rate of 100%. Many companies do. On materiality, I said accounting standards are intended to be applied to items which are material. I've seen large corporates, large PSUs even charging depreciation on assets costing less than 25,000 at the rate of 100%. So materiality will prevail. But we have an application guide also. We have an application guide on Schedule 2 issued by our Institute of Chartered Accountants of India, which deals with situation as to how to charge depreciation, how to calculate depreciation in different situations. They have also said it categorically that in respect of assets whose useful life does not exceed 5,000, you can continue to provide depreciation at the rate of 100%. Component approach. We are very fortunate that for financial year 14-15 we do not have a component approach. So I skip this component approach because this is not mandatory for this year. It will be effective for financial year 15-16. But for those of us who are dealing with listed companies, when it comes to your quarterly review, when we prepare the June quarter results, then perhaps we have to consider even component approach by calculating depreciation on fixed assets. And it is one of the toughest exercises. Charging depreciation is not a tough exercise. One time it will take a little time of us, but it is not at all tough. It is fairly simple. But when it comes to component approach, which you will implement from the current year, it is really very difficult because we as auditors are not competent to divide the asset break up the asset into different components. Can we say that this life of building life has 60 years, but this ceiling has a life of 20 years, your flooring has a life of 15 years, your exterior interior walls have different life. So now you first break your assets into components and then charge depreciation based on the useful life of each component. So for this building, excluding this ceiling, flooring, interior and exterior wall, you charge on 60 years. For this flooring you charge, for this ceiling you charge 20 years, for this flooring you charge 15 years. There is a big problem ahead of that when it comes to taxation. What they say, if you are following component approach, say I am following component approach for flooring, after 15 years I replace the flooring with a new flooring, say after 15 years or after 16 years or after 14 years, I replace this flooring with a new flooring. Then what they say, whatever amount is lying in your block, WDV, net block, knock off that WDV from your fixed assets. So if I have a cost of say 25 lakhs for this flooring, which is included in building, and it has depreciated till 22 lakhs, say 22 lakhs. So WDV is 3 lakhs. Knock off this 3 lakhs from your block of assets. So 25, 22 both gone. 3 gone. What do I do then? Capitalize this. Capitalize the cost now which you have incurred, say 50 lakhs, to the cost of the asset. Very well, I have done the capitalization as the ministry has said. What happens to tax? All along we have been arguing before the tax department that if I have replaced my ceiling, I have replaced my flooring, I have not incurred a capital expenditure. It is incurred for their maintenance. All along we are arguing this. We have incurred for their maintenance. There is no increase in life of the asset, there is no durability. All those arguments we have all along been giving and successfully winning the cases, successfully being able to argue the case before tax authorities. But now, if we ourselves capitalize it as a part of the cost of the asset, there will be great difficulty in claiming allowability of this expenditure as a capital expenditure, because the tax department may say you yourself capitalize as a part of the cost of the asset. So why should I allow you now? There is a challenge. although it is said that entries in the books of accounts are not determinative of the nature or character of the expenditure. We have Supreme Court judgment on this. I may charge something in my books of accounts as a capital expenditure. I can claim that expenditure as revenue expenditure while calculating or computing my tax. In my books I capitalize it, but in my computation I claimed it as a revenue expenditure. It is allowable. We have an ample number of judgments of this. I may not even choose to provide certain expenditure in my books of accounts. I prepared the balance sheet on 7th of April. By the time I prepared the balance sheet, I omitted to charge a number of expenses in my PL account. I still have the option of claiming all those expenses which I have not provided in my PL account in my computation of income. Law permits that. You need not. For the purpose of claiming any expenditure, it is not necessary that it should be debited to the PL account. It need not also be debited to PL account, provided it has been incurred for the purpose of the business for the previous year to which we are claiming, and it falls within the ambit of 32 section 37. So we still have the option, but when we follow component approach, this will be a challenge, because now what we are doing, all such repairs we are charging to profit and loss account. But when we follow componentization, it will be a big challenge. As to again, how do we break the assets into components? Large companies may not be a problem. They have ample team, they have resources. But say mid-tier companies with assets of 10 or 15 or 20 crores, how do they do? And first, as an auditor, how do we ensure whether componentization is required or not? So this will be a very big challenge. And unless institute gives a guidance on this, it will be very difficult for us to implement this componentization. Then additional depreciation on revaluation. There is a big change when it comes to revaluation. What we had discussed earlier, whatever incremental depreciation was there on account of revaluation, that was recouped from revaluation reserve. So there was no impact of revaluation on your financial statements, on your profit and loss for the year. But now what they say, that is why I said, let us see this definition. Depreciable amount. Depreciable amount is the cost of the asset or other amount substituted for cost less its residual value. So when I have revalued my asset from 1 crore to 10 crores, what is my depreciable amount? 10 crores. It is cost or other amount substituted for cost, less residual value. So if I have revalued my asset from 1 crore to 10 crores, my depreciable amount becomes 10 crores less residual value. And section 123 says that depreciation has to be charged on the depreciable amount over its useful life. So now we have to charge depreciation on this 10 crores to our profit and loss account and say the rate of depreciation is 10%. What will be the amount of depreciation? What will be the amount of depreciation? 1 crore. So this 1 crore in entirety will be needed to be charged to profit and loss account. Yes. So what happens to my revaluation? I have revalued from 1 crore to 10 crores. On account of this, assuming rate of depreciation 10%, I charged 1 crore to PL account. Earlier I could have adjusted 90 lakhs through revaluation reserve. Now I do not adjust this 90 lakhs through revaluation reserve. Entire 1 crore is charged to profit and loss account. So what happens? My profit is impacted, my dividends are impacted, my managerial remuneration is impacted. Will I get any benefit of this under MAT? Under minimum alternate tax, will I get the benefit of this incremental 90 lakhs which I have charged to profit and loss account? Possibly not, because even it is as per law. Possibly not, because under 115 JB they have stated that you will get deduction only to the extent of depreciation attributed to your original historical cost. So under MAT,
What about that revaluation value?
yeah, we are coming.
Debited, which one is credited?
Sir, we will debit depreciation, credit fixed assets.
Asset value increased.
Yes.
That means asset is debited by 9 crores.
Revaluation reserve will be created.
That is income.
No, that is not income, that is reserve. If I have revalued the asset from 1 crore to 10 crore, fixed asset will be debited, revaluation reserve will be credited.
That figure can be adjusted to dividend.
That reserve cannot be adjusted, dividend cannot be declared. Now we have specific provisions under 123 that dividend can be declared only out of free reserves, and they have defined free reserves in section 2. And what constitutes free reserves?
That is capital reserve.
Yes, revaluation reserve is a capital reserve not available for distribution as dividend, not available for distribution for capitalization as bonus shares as well. You cannot use revaluation reserve for issuing bonus shares. Section 63 of the Companies Act specifically bars issuance of bonus shares out of. So now what do? I will not get the benefit of my. Now what do I do with my revaluation reserve? 9 crores is lying there. What do I do?
Write it back.
Write it back to?
Yeah, basically.
I.
The same point.
Where?
Take back the profit and loss.
Section 123 does not permit. Section 123 says that depreciation has to be charged as per schedule 2. So I have to debit 90 lakhs, 1 crore, including 90 lakhs to PL account. I cannot debit depreciation, reduce depreciation by 90 lakhs because schedule section 123 schedule 2 does not permit.
Then this will come as a separate item of write back in the profit and loss.
Then I am inflating my by virtue of what? What if I have to write back? I will write back revaluation reserve to the extent of 90 lakhs.
That's it.
If I write back 90 lakhs revaluation reserve, in effect, I am reducing indirectly. Instead of directly, I am indirectly reducing my depreciation. Earlier, we used to follow this treatment because we had a guidance on by our Institute of Chartered Accountants of India. Institute had issued a guidance note, and this guidance note stated that to the extent of difference between original cost and your revaluation, you can transfer from revaluation reserve to your PL account. That was there. So after this act coming into effect, there is a question whether that guidance will have any persuasive value when it comes to adjustment of depreciation on account of revaluation. So what do we do now? Our application guidance stated that in such a situation, transfer this 90 lakhs from revaluation reserve to general reserve. We will transfer this 90 lakhs from revaluation reserve to general reserve. You cannot transfer 90 lakhs from revaluation reserve to profit and loss account. Application guidance clearly stated that you cannot do this. So now we have to transfer 90 lakhs from revaluation reserve to general reserve. So our profits are affected, and this will go on effect year after year till revaluation balance is there. We are not getting any benefit out of this. We are losing on managerial remuneration if it is linked to profits. Even if we are following, say earlier we were following schedule, now we have section 190, schedule 5 of Companies Act when it comes to managerial remuneration owing to inadequacy of profits. There also our calculations will be disturbed, dividend will be disturbed, tax will be disturbed. We are not getting any benefit out of this. So this is a real challenge under this new law. A bigger challenge arises when, say, we have a, we have a asset whose useful life has expired. Say we have a block at 10 crores, plant and machinery, 1 crore plus 9 crores. The useful life of asset is expired. Assume the useful life of asset is expired. Now what do we do with 10 crores? We have to charge it to retained earnings or to PL account. Can we charge entire 10 crores to retained earnings or to PL account? What happens to the revaluation reserve in that case? Our application guide does not provide guidance for this, but we have to do some logical conclusion. So what can be the logical conclusion? Two ways: either charge this 10 crores less residual value to your statement of PL or to retained earnings, then transfer from revaluation reserve to general reserve. This could be one option, but then our financial statements will be distorted, materially distorted. We choose another option. Revaluation reserve, the assets, we directly adjust against revaluation reserve. 9 crores, whatever balance is there, 9 crores, this asset, instead of charging to PL and then transferring from revaluation to general reserve, we directly adjust the cost of assets against revaluation reserve on the plea that under transitional provisions, we may charge to retained earnings. So I have the option to charge to some place other than retained earnings also. So in respect of assets whose useful life has expired and there is a revaluation balance left, I choose the option to charge the WDV of the assets to the extent of revaluation directly against the revaluation reserve. In my view, this is possible, but others may have a different view, because if I choose the option to charge entire amount of 9.5 or 10 crores to PL account and then transfer from revaluation to general reserve, to my mind, this will not be an appropriate accounting treatment, plus your financial statements will be materially impacted. Yes, ma'am.
Due to this depreciation or revaluation amount, I am not able to declare the dividend. And if for that, if I transfer the revaluation reserve to general reserve, now general reserve is a free reserve.
This is a big question. I was coming to this question. Now, when you transfer from revaluation reserve to general reserve, can you consider general reserve as a free reserve? They have defined free reserve in subsection 43 to include reserves realized in cash out of profits. And again, if you have mark-to-market adjustments or fair value adjustments, they have also included that. Keeping in view our IFRS and IAS, that if you have some mark-to-market adjustments or your fair value adjustments through your profit and loss account, even that will be excluded while calculating free reserve. So in effect, we presently do not have any fair value adjustments because most of us are not following AS 30, 31 and 32. So assuming those adjustments are not there, can we say that whatever amount is lying in general reserve is nothing but a free reserve? It is a big question. To me, it is a big question. Why? Because now this general reserve is created out of revaluation reserve. So this is not realized in cash. Now can we argue this? Ministry have to clarify. This is really very confusing. Even when they have made this provision for depreciation on account of revaluation, perhaps they have intentionally done it or not, I do not know. But we had a guidance under accounting standard AS 10, and even for that matter, in the guidance note on depreciation or revaluation reserve issued by our institute, it states that it is always prudent. Whenever you have revalued your assets, it is always prudent to charge the depreciation on revalued asset directly to PL account. Do not disturb revaluation reserve. Year after year, transfer from revaluation to general reserve, or in the year of sale, transfer from revaluation to general reserve. What was their logic? Their logic behind this provision was that in inflationary situations, you must debit an amount which is equivalent to recover the cost of the asset. Say I have purchased a building 10 years ago, 20 years ago for a cost of 10 lakhs. Say I had let out that building on rent that 20 years ago, that building costing 10 lakhs. Say I had let out for a rent of 60,000 or 70,000 per annum, 6,000 per month. 6 to 7% normally yield comes on your residential property.